Hello, everyone, and thank you so much for coming tonight. We are very, very excited. For those of you who don't know, my name is Matt Metters, and I'm the Chief Operating Officer for HOA Organizers. We are a full service HOA and community association management company serving the great states of California and Washington. We are very excited tonight to discuss everyone's favorite topic, insurance. As you all are aware, insurance is affecting everything from, one, your ability to get insurance, but also your ability to afford insurance, both for your communities and for your individual homes and condos. So tonight's presentation is really going to be about kind of a state of the union of the insurance marketplace, and also what you as community association leaders and as homeowners can do to put yourselves in the best position. So I will introduce our speakers. First, Charlotte Allen walked through the doors of Social Insurance Agency in 2005. Since then, she has successfully aided in the acquisition and retention of nearly 3,000 common interest developments. As Director of Education and Industry Partnerships, Charlotte works collaboratively with fellow agents to highlight Social's service, knowledge, and dedication. Her commitment remains focused on educating common interest developments and their managers. In 2017, Charlotte earned her designation as a Community Insurance and Risk Management Specialist, CIRMS. Charlotte's an active participant in CAI, ECHO, and CACM, which are our industry's trade organizations. She has curated hundreds of seminars, trade shows, and speaking engagements. She's also a loving wife and mother of two and spends countless hours volunteering in and around her community. Her hobbies include cooking and reading, and you can find her most weekends on a field watching her son charismatically play soccer. So we all are watching everyone play soccer right now. It's the first time we Americans have heard of it. And then we have Patrick. Patrick Prendeville started Prendeville Insurance Agency in 1988 after graduating from UC Santa Barbara. Patrick has earned the Community Insurance and Risk Management Specialist, CIRMS designation from the Community Associations Institute. Over the years, Patrick has been actively involved in multiple chapters of CAI as a guest speaker, past president of the Orange County and San Diego chapters, and as a presenter at multiple national seminars. We're very excited to have these two titans of the HOA insurance industry with us tonight, and I will hand it over to them. So take it away, Charlotte and Patrick.
Thank you so much. Really appreciate it, Matt. Thanks for having us. So we're going to talk about what's going on in the insurance market, and we're going to hit it off first, talking about some of the background issues that we've had. And one thing I want to talk to you about that's super important to kind of set the table for what's to come is this whole concept of reinsurance. And so I'm just going to tell you a quick little story, and then we'll talk about why it matters. But what we have going on is a situation where just to give you a real world example, I went into an insurance company, can't say who, after the Santa Rosa fire. And I was talking to one of the executives there, and I said, but how is it going with the fire recovery? They lost many, many homes and businesses in this fire. And they said, the executive said, actually, they're doing pretty good. They're capped out about $250 million. I knew right then what he was talking about. He was talking about this concept called reinsurance, which is really spreading risk. And so what happens when you pay your insurance premium without you being aware of it, of course, they have expenses. One of their expenses is to turn around to other insurance companies that are specialists in reinsurance products. What they do is they spread out the entire risk so that in this case, when this particular company lost $1 billion worth of property in Santa Rosa, their cap was $250 million. And so that is how the insurance works. Unfortunately, and this goes back hundreds of years, but unfortunately now you have all these wildfires going on because Santa Rosa was 2017. Then you've got, fast forward all the different fires, and it's not just fires, it's hailstorms, it's, earthquakes, it's floods, it's all sorts of calamities. We've had a lot. And so what happens is the reinsurance companies have to pay all these losses. And then what they do is they have to shrink their appetite for taking on more risk. That shrinkage of risk results in, obviously, an increase in premium. It also goes through a situation where you have a really keen underwriting eye on your association and what's going on with that. And so this is something that is really fundamental to understand, that we are in a reinsurance crisis. The good news in 2026 is we are slowly thawing out of it, I think, but it has been a really rough 4 to 5 year period, what's called a hard market in the insurance industry. So now Charlotte's going to tell you some of the downstream effects of that. So hello, Charlotte.
Hello, Patrick. Thank you. Yeah, so Patrick was talking about the appetite of these carriers and what it is that they are scrutinizing now more than they ever had before. Patrick and my careers go far back, but this is definitely the longest hard market either of us have ever experienced. And these insurance carriers are scrutinizing things now in the last 4 or 5 years that they maybe didn't pay as close attention to before, say 10 years ago. So the biggest one right now is deferred maintenance. Insurance companies are never meant to be maintenance policies. They are insurance policies, and they're really taking a close look at aging infrastructure. I take great offense to this, but of course, anything that's built prior to like 1990, these insurance carriers are considering that aging infrastructure and really want to have a lot of details as far as the maintenance goes. What have you been doing preventatively to your association, to your property to prevent losses from happening? So some of that, again, the deferred maintenance that we're talking about is, aging roofs, electrical and plumbing situations. They're really asking those difficult questions. What has been done and where's the proof of what's been done? Um, the other is, of course, California and many states on the West Coast, wildfire risk. I think especially in the beginning of the hard market, we were so quick to point the fingers at this is a wildfire problem. This is at-risk properties that are in high wildfire areas. And really, we've come so far away from just that being an issue. Certainly, we have a lot of properties that face this issue of, hey, we're in a dense area, we're facing some wildfire risk. But I'll tell you, the majority of the properties that I insure in Northern California are not experiencing the wildfire issue as much as the deferred maintenance and other issues that insurance carriers are really scrutinizing. I call this the four-letter word of the insurance industry right now. But anyone out there that hasn't heard of Zinsco electrical panels, consider yourselves lucky or living under a rock.
Yeah.
But these insurance carriers they do not like Zinsco electrical panels. They also are having issue with other panels such as Challenger, Stablock, Federal Pacific. The list continues to grow. But basically, these electrical panels, most insurance carriers are asking that you replace them with safer electrical panels, newer electrical panels, or you might be facing non-renewal or cancellation of coverage. An aging building, again, they want to make sure that you're doing all of the necessary repairs and that you're avoiding loss. This is kind of a frustrating one, but even the cost to rebuild has become an issue for some of our standard insurance carriers. So 10 years ago, we had insurance companies chomping at the bit to write a large high rise, newer construction, fully fire sprinklered, and all the bells and whistles, zero loss history to speak of, and they wanted to eat those up. Well, now they're really looking at what's the total insurable value of this large property, this, stacked high rise. And they're saying, we're not comfortable taking on a risk more than 75 million or 100 million in total insurable values. So some of the appetites of those insurance carriers has dwindled for those larger properties. And we're really looking at just a small few carriers that are willing to write the larger properties. And then, of course, this is something that's always been looked at. Loss history is a part of assessing a risk. We've always had to submit to insurance carriers, including usually a 5-year loss history report. But nowadays, insurance companies were really kind of focused on what was the loss ratio? How much does an insurance company collect in premium versus how much are they paying out for those losses? Well, now insurance companies are really paying closer attention to the patterns that they find in the loss history. So if they see, oh, you know what, this association might be a really great association, but the last 5 years they've had 3 small water losses. Wasn't a huge payout, but they're scratching their heads and going, what is happening here that's causing them to have multiple similar losses, like these water losses? And again, that's going to circle us right back to what is the preventative maintenance that's been done to prevent these losses from happening again. So We did see a lot of folks jump up in premium. So they went from, let's say, this is an example, this is a real life example. We had an association that was paying $25,000 in annual premium for insurance, and suddenly they jumped up to $225,000 a year for annual insurance premium. And here's the thing, it's not because you were insured by farmers or travelers for the last 20 years and suddenly you saw your premium triple, double, triple, quadruple. It's usually because you've gone from that standard market to what we call a surplus lines carrier, and you're now paying more for that coverage. So this might be a review for some of you, but let's just talk about the difference between a California admitted or state admitted insurance carrier versus the surplus lines market. A state admitted insurance carrier has to adhere to their specific state's Department of Insurance. So they have to run their rates by the Department of Insurance. They have to file their policies through the Department of Insurance. Everything is regulated and they cannot charge anything outside of what has been approved by the Department of Insurance. And so for a long time, especially in California, and I won't get into the politics of Proposition 103 back in 1988, but for a long time, we did see a lot of insurance premium at a very artificially low amount. And for decades, we saw that. And so the California admitted or the state admitted insurance companies, again, they charge only what is approved by their Department of Insurance. A lot of times there are guarantee funds to back up a state admitted program. For instance, in California, we have what we call the CIGA, C-I-G-A, California Guarantee Fund. And basically what it says is if you are insured by a California admitted insurance company and you experience a loss and that company goes insolvent and cannot pay your loss, that you've got up to $500,000 in this guarantee fund. But let me tell you, if your association has experienced a loss and your insurance company has gone insolvent and can't pay that loss, $500,000 is probably not going to get you very far. So although we love a guarantee, I just want to call a spade and tell you what that guarantee fund really is. And we saw a lot of, again, those state admitted markets kind of decrease their appetite on what they were comfortable writing and what they would write in each state. So we ended up turning to the surplus lines market. Now, surplus lines carriers might be new to you, or a few years ago, they were new to you. But I'll tell you, any insurance professional that's been in this market for some time, the surplus lines policies are not new to us. And so we've been working with them and utilizing them for our harder to place risks for some time now. It's just really important that we pay close attention to the policy, to the endorsements, and to any exclusions. I'm a firm believer that a policy is only as strong as its endorsements and only as weak as its exclusions. So we just want to pay close attention to those surplus lines policies. They're not cookie cutter. They're not kind of those standard carriers or standard policies that we typically see from a state admitted insurance company. But if we pay close attention, I'm very grateful to the surplus lines market because they were able to ensure a lot of our clients that weren't able to find coverage in the standard market and make sure that they were adhering to their governing documents, to Fannie and Freddie guidelines, to best practice, and of course, individual state statutes. They are typically more flexible in their underwriting appetite. They can often endorse policies through a manuscript endorsement. There's a lot of flexibility there. However, they get to rate for the risk or based on the risk. So the premiums that they're collecting is based on what they think the risk entails versus having to cipher that through the Department of Insurance. So we did see those premiums increase. I will say the silver lining to the surplus lines market right now is the standard market is still kind of feeling that hard market with definitely some silver lining and some relief coming. However, the surplus lines market is experiencing the softest market they ever have in some time. And so a lot of our clients that were getting, had to turn to the surplus lines market a couple of years ago, haven't quite done the maintenance that they need to do to get in the standard market. They're actually seeing some of those surplus lines premiums come down. I just was able to save a client a couple of weeks ago $40,000 upon renewal. They have to stay in the surplus lines market because they're not quite ready to go back to standard. They still need to do some replacement, some maintenance work, but they were able to see a savings in the surplus lines market.
Yeah, really great points. And I'm seeing the same thing. In fact, I think the California Fair Plan, which I want to talk about now, is one of the big reasons why we're seeing the softening market. Because in the past, the California Fair Plan was very limited in what they would accept as far as the total insured value of a property. They were very small. They had a very small appetite, actually. It was something like $8.5 million, and they went to $20 million. And the industry, and I serve on a group that's called the Wildfire Task Force. We and others have gone to the Department of Insurance and the Fair Plan and said, listen, we're not dealing with the condo associations that are under 20 million in total insured value. We need to increase those numbers, because it's just funny that they all seem to be like 50, 60, 70 million total insured value. Of course, there's a bigger range, but a lot of them are in that little curve. And so fortunately, the California Fair Plan, and this was weeks after the LA fire, weeks after they put a $1 billion assessment to the insurance industry. And quite frankly, I was very pessimistic. I thought, well, there goes our months and months and months of negotiations down the tubes, because how are you going to issue a $1 billion assessment and then turn around literally within weeks and say, hey, we're going to take on more risk? But that's what they did. Political pressure works, and they got to a $100 million limit. $20 million not to be exceeded in any one building, which is not really a problem. I haven't really seen that yet, but that's really good news. And so when the Fair Plan came on, we did see excess of surplus lines policies fearing that they were going to lose policies to Fair Plan, which they did, but they really started dropping their premiums. So that's good news. But the Fair Plan is if you're in a situation where you have a very expensive non-admitted excess of surplus lines policy, if you haven't looked at the Fair Plan, you might want to just to go through that effort. It's something your broker should be doing for you. I know Charlotte and I have both done a lot of Fair Plan. I think there's some brokers in our industry, shame on them, but they don't really want to go through it. It's kind of like dealing with the DMV, quite frankly, but it's really important, especially if you're an association that doesn't have enough wildfire coverage. Fair Plan can really help you solve that issue. The other thing we have is we have pooled policies and shared limits. And I know that Charlotte and I agree on this one. It's like there's a place and a time for everything, but this is not something that we should really be embracing on a regular basis if we have alternatives. The reason for that is this. A pooled policy or a shared limit policy is where many different associations come together under one master policy. They might have a $500 million limit or even a $1 billion limit, but it could be as low as $215 million. And basically what happens if you have a fire in a geographical area, like the Palisades, for instance, you have multiple associations get burned in that fire. If that pool runs out, they literally will tell you up front, you will only get a pro rata amount of what there's available. So if the pool is depleted, your insurance coverage will be depleted. So California Fair Plan is always kind of written about in the paper. When you read it, it says the care of last resort. And that is true. I'm not going to really dispel that, but I will add one thing. Except for pooled shared limit policies, maybe those are the carriers of last resort, because that really is something that can be concerned about. So be a little careful of that. If you get a pooled policy, really look at the details to see exactly how big is that pool and how many people are in the pool if you can find out. So just be very mindful of that, because they're really becoming popular now. More so.
Yeah, no, I'll just add to that my biggest issue with a pooled or shared limits program is most of the time they are not going to meet the Fannie and Freddie guidelines. So, you may end up with a surprise. You take one of these pooled programs, and it's usually because you purchased it through an insurance provider that really didn't know how to explain it, how to educate you on what it is. But unfortunately, midway through the policy, you find out because a unit owner is trying to sell their unit and can't, that it doesn't meet the Fannie and Freddie guidelines. That is not the time to find that out. You should be getting this education up front.
Yes, absolutely. Great point. So to the real meat of what we're here for tonight, let's talk about the uncomfortable truth, which is your HOA policy is one policy that benefits your association and benefits you. However, you have to carry another policy, and that's what we want to talk about. The key in making this work is to make sure the two are consistent with one another. Your HOA master policy is typically going to cover the common area structures, however that's defined. Obviously it'd be clubhouse, pool, private streets. It may or may not be your residential structure. Kind of depends on what the definition is there. Shared amenities in the grounds, of course, general liability in case somebody trips and falls or there's property damage. And then, of course, for many of you on this call, board member or committee member, directors and officers coverage, and then also fiduciary coverage for theft of money. The individual policy is going to take care of everything else that's not there. And let's go to the next slide and we'll talk about a little bit deeper on that. Thank you very much. It's super important that you guys know exactly what does your association cover as far as your interior. This is probably the blurriest problem of them all when you're looking at this. You want to see what the CCNR say. Is this a bare walls policy? Is it an all-in policy or a single entity policy? And let's just go through each one and talk about it. So the least amount of coverage from the association perspective and from your perspective as well is it's a bare walls, which there's a pretty good representative photo of it. And what it means is the association policy is going to rebuild your residential structure, starting from the outside, going into the walls. They're going to have the wiring. They're going to have all the rough plumbing, rough electrical, insulation, and then they're going to stop at the finished drywall. Okay, that picture is a little off, maybe a week or so, but it's going to be the finished drywall only. You have no flooring, you have no countertops, you have no fixtures. You can't live there. It's just simply a structure. And so that is what we call bare walls. Then the next category in line here is called all in, which means that no matter what was inside that unit, as long as it's permanently installed, so it's flooring, countertops, cabinetry, high-end wood, whatever it is, the association policy is going to take care of that come claim time, regardless if the developer put it in or if you put it in or a previous owner, it doesn't matter. As long as it's permanently installed, the association policy is going to take care of that. Then you have the third category, which is single entity, also called walls in. And think about it from this standpoint. This photo shows something that could have been built like in the 1990s, maybe late 80s. And it's got tile floor, it's got nice cabinetry, but you wouldn't say that's a modern kitchen. Well, if you have a walls in or single entity policy, your association insurance policy is going to give you back an allowance for those items. Your own personal insurance then makes up the difference for any changes that you or a previous owner have made. And so you have the three. You have bare walls, all in, and single entity walls in, radically different. And it's important for you to have an understanding of what's included in each and what your governing documents say. Once you have that information, then you go to the personal side. So this is now the individuals buying the policies. And if you're living in a single family home within an association and you have a situation where the association does not insure the actual structures, then what you would have is be called an HO3 policies. That could be if an attached or a detached home. And it's going to cover things such as your personal property, your building interior and exterior being the key, liability, loss of use, and loss assessment. Okay, sometimes you'll find homes that look like homes, but they're insured by condos. Charlotte, off the cuff here, sorry, but what do you call those? Do you have a nickname for those? We do.
Oh, I don't have a nickname, but I always tell people never trust your naked eye. You've got to look at the governing documents because I can't tell you how many times I've walked into an association that the naked eye tells me these are single family homes. They should be insured as single family homes. And you read the governing documents and lo and behold, that's not how the master policy is to insure them and vice versa.
Yes.
What is your nickname?
Well, your definition is very good, by the way. But we simply call them home does. They're homes, but they're insured like condos or home does.
I love it. That's cute. I'm going to use it.
So the HO6 policy for your true condo policy, where the association is insuring the exterior, whether it looks like a condo that's stacked or a home, it's an HO6. And what it covers personal property. It covers building interior, liability, loss of use, and loss of assessment. Now, the next slide is going to show us a side-by-side for simplicity. And you'll see there's very little difference, but there is big differences. The building exterior. You can see on the left-hand side, the HO3 policy, single family home, building exterior is covered. Go to the right, it's stricken out. So we don't cover the building exterior on a condo association. Everything else is the same except for one little tidbit, and that's loss assessment. On an HO3 policy, single family home, you can add loss assessment, but oftentimes you'll have to ask the agent or the company to specifically add loss assessment. I think it's a smart idea because the premium is very, very small, and you might have a claim to the clubhouse that maybe is not insured properly, maybe has a huge deductible, and you get this bill because it caught on fire, or maybe it's a big liability claim. It would be nice to have loss assessment even if you're in a single family home. Now, the other side, HO6, you don't have a choice. You get loss assessment whether you ask for it or not. However, you want to check your limits. They might come out and say, we're going to give you $2,500 in loss assessment, but getting to 25 or as high as $50,000 loss assessment could be very inexpensive. And we always recommend that you get enough loss assessment, especially if it's just a few dollars, $10, $20 a year. It goes a long way. So check those things out. But that's a nice side-by-side for you that will show you the differences between the HO6 and the HO3. And again, we get this from your governing documents as to where we have pulling the coverage on that.
And just like the master policy, your personal lines policy is only as strong as your endorsements and as weak as your exclusions. And so one thing that we don't mention on here, but I think, Patrick, it behooves us to mention it, and that's loss of use coverage. And I only say that because I've had so many homeowners in my career be surprised when they have to leave their unit for a repair, and they assume that the association's insurance is going to pick up that hotel bill while they or Airbnb while the unit gets repaired. And do you want to just go ahead and quickly add that in? I know, again, we didn't put it on the side by side, but I think it's so important because we have a lot of homeowner members on the
call.
Yeah,
no, the loss of use is there on the side by side, but it is really
oh, you're right.
Yeah, I kind of glossed over it. And so I'm glad you really focused on it because you're right. There's nothing more depressing than talking to somebody. And I'm not talking about like a few days out of your home. That's bad. But what if your house burns down? And I have literally been on scene talking to people when the Red Cross shows up and discover they have no insurance. The Red Cross, I learned this the hard way because I drove someone to a Motel 6 to drop them off. It was like midnight. They give you 2 days of hotel at a Motel 6, which is better than nothing, but it's 2 days. So that was 15 years ago. Maybe it's changed. I'll guarantee it hasn't changed much. So the point is, yes, loss of use, critically important. And
not covered under the master policy.
That's not covered. They have no obligation to do that. I mean, the only time it's ever covered is if you have a liability concern where the association caused you damage, then there may be some loss of use or a liability claim, but that's a different story altogether. That's not where we're focusing on. We're focusing on a property claim. You need to have the coverage on your personal policy for sure. So thank you for that. Yeah, and here's just a little more illustration on that loss assessment, which is really important. So a claim happens, and that's the key. This is not a loss assessment for, hey, we misjudged how much it would be to re-roof or to repaint, so we're short, we're going to send you an assessment bill. We're not talking about that. That's not covered, unfortunately. But we're talking about a water damage claim, fire, liability, anything like that, any insurance-related item. Could be a deductible recovery. And then what happens is, the association might send the bill to you as a special assessment. You then go to your individual insurance policy, you pay your much smaller deductible, and then you get recovery for that. It's a very good coverage to have. And as I said, it's very inexpensive.
Okay, so where are we now? We've thrown a lot of really valuable information at you. We gave you some good little visual images there of the types of policies and what each type of policy would bring your particular unit back to. Now, the question is for all of you to individually go and find out what type of policy do you have. So you want to ask your board or your community manager, hopefully you're working with someone at HOA organizers, and find out what type of policy do you have at your association so that one, you can make sure you have the right coverage and you can share that information with your entire membership so that all of the members have the right type of coverage. You want to make sure that you get that information out so that they can purchase the correct policy, either an HO6 or an HO3, and again, get all of the endorsements based on the type of policy you have and the limits that you have, and paying close attention to what could my deductible be based on the master policy, and making sure that you're increasing those personal lines limits accordingly. And again, just a review, checking those loss assessment limits, checking that you have loss of use on your personal lines policy. This is just a real great checklist for you to briefly go through and make sure that you're comfortable and understanding the coverage that you have.
Can I just add on that, Charlotte?
Yeah, please.
So I would just say for board members and managers that happen to be listening tonight, I would really encourage you to make it so that rather than just sending out your annual insurance disclosure and your certificate of insurance, send out a separate document, which is like a little buyer's guide for homeowners to be notified that they need an HO6 or they need an HO3 and like what things to look for. Maybe a little checklist of who insures personal property, who insures the air conditioner, who insures the front door, all of those things. It can be done very simply. And if you're dealing with an agent that specializes in home insurance, they already have a template for you, I promise. I know that Charlotte's office does it. We do it. Most of our competitors do it. Really important, though, to send that out. And one thing I really like about it is it really eliminates an uncomfortable board meeting when somebody comes to the board and says, I never knew. And now, look, we all agree they should know because they got the CCNRs and like they have responsibility. But it's really nice to be able to point out, you know what? Once a year, we send you out an insurance disclosure. We also send you out an insurance buyer's guide every year. And here it is. And I'm sorry you didn't see it. It's really a nice thing to send out. And I would also just end it with, if you did a poll of how many people have insurance in your community, you might be shocked with how few. If you do the poll immediately after, maybe 2 weeks after sending a letter like that, that number will go up. And these letters do work.
Yeah, completely agree. And I'll tell you, I'm the first to admit that sometimes when you're overwhelmed with these documents, and frankly, reading these governing documents, the CCNRs that were written by attorneys in, all this legal jargon, it's really hard to understand exactly what it is. Even a certificate of insurance, which is a summary of coverage, can be really hard to determine what is this jargon? What does it mean? So that letter that really spells it out. And again, Patrick is correct. Most of us have templates already. It's easy enough for us to go ahead and complete those and get them out to you. It can be really helpful to, one, break it down and understand what kind of coverage the association has so you know exactly where your personal lines policy needs to begin. And if you're having trouble even deciphering that, that's okay. Hand that over to your personal lines insurance provider. Absolutely. There's nothing easier than having two insurance folks talk to one another. We can use all the insurance jargon and acronyms we want to, and we'll both understand it completely. You can give that letter over to your personal lines agent, and we can close up those gaps for you. So, just putting this out there, the HOA insurance policy, the master policy, was never meant to work in isolation. It needs to have that personal lines coverage to close up those gaps. And that is our big driving point tonight, is to make sure that you're comfortable with what you have. Now, I want to talk to you a little bit about what to look for in your insurance partner, because I'll tell you, we're not all created equal. Patrick and I are incredibly dedicated. Again, we're both CIRMS designees. We're very dedicated to educating our clients and having a very rich understanding of insurance specific to homeowners associations, but not everyone out there does. So I just want to briefly cover some of the green flags and some of the red flags that you might want to look for when you're interviewing and finding the right insurance provider for you. You really want to make sure that you're working with someone that's communicating proactively. They should be reaching out to you. And I can't tell you, and Patrick, I know you agree, because we've inherited clients that have this complaint. They're like, oh yeah, 10 years ago, I met a broker. They hooked me up with a new policy and I haven't seen them in 10 years. I haven't heard from them in 10 years. Or especially, years ago, we would see this. They haven't increased my insurance in 10 years. You would see the same insurable value year over year, not taking into consideration inflation. Thankfully, there's been some rules that have tightened up, and Fannie and Freddie have gotten involved and kind of forced us to insure correctly. But I can't tell you how many deck pages I saw, 10, 15, 20 years ago that were coming through, and year over year, it was the same limit over and over again. That's not how inflation works, guys. We do know that there is increased cost of construction that we need to take into consideration. Someone that's taking an education first approach. This should be about education and transparency. I just said it can be really hard to understand. It can be really hard to go through an insurance policy, read all of this jargon, and really have a clear understanding of what is or isn't covered. So working with an approachable insurance provider that can break it down for you and give you a real sense of what those policy forms mean or don't mean can be really valuable. The renewal process should start early. I was actually just doing a presentation with one of Patrick's counterparts a couple hours ago, and we were talking about this. Sometimes your renewal, right? We have a year-long policy period. Sometimes your renewal may take 6 months to a year of a process. And here's why. Because a lot of what we're doing to get you back into the standard insurance market and out of surplus lines is making sure that you've done the appropriate maintenance to get you back into more affordable premiums, more standard coverage. And so we should be collecting that information and having those conversations with you early and often. Any preventative maintenance that you're doing to the association should be shared with your insurance provider, not right at the renewal date or just before the renewal date, but as the policy period goes on. So the renewal process truly does start early, and you shouldn't just be hearing from your provider, once a year or once every 10 years. They should understand your property. You are not just a policy number or an association name, but they should really have an understanding of what your property looks like and what challenges you might face. One of the things that I stand by, if you ask us to quote insurance for you, the first thing that we're going to ask for is let's see those governing documents if we don't have them already. And the second thing is I'm going to say, is there a gate code or is there someone that can meet me out at the property? Because I'd like to take a look at it myself. We don't want to have surprises 3 months into a policy. We want to have a real understanding of what the association looks like so that we can help guide you to the right insurance product that's not going to non-renew you when they find a surprise 3 months into the policy period. And industry involvement. It doesn't have to be that they're at every networking event, but they should have a really clear understanding of homeowners associations, of the laws that govern them. One of the red flags I talk about a lot is if you're working with someone that doesn't know what the Davis-Sterling Act is or state statute or what governing documents or CC&Rs are, that's a real red flag. You want to work with someone that has an understanding and has some real involvement in homeowners association insurance. The red flags are kind of the opposite. If they're hard to reach, if you haven't heard from them in 10 years, if they're reactive only instead of being educational and proactive, if they can't explain insurance coverage in plain English. And this is a big one. And this is one that drives me absolutely crazy. And I'm sure Patrick agrees because it really kind of puts a bad taste in everyone's mouth around insurance providers. If you are getting your renewals last minute without explanation, okay?
Without explanation, yes.
I want to be really clear here. So first of all, the state admitted insurance carriers are offering us, the brokers, the agents, your renewal typically at about 30 to 40 days before the renewal date. Those are your state admitted standard insurance carriers, your household names, if you will, Farmers, Travelers, Philadelphia. We're getting those 30 to 40 days before your renewal. So our goal is to check those, make sure that they're accurate for what we want to present to you. And there's no reason that we should be holding on to those renewal options. The board should have optimal time to review the renewal or other renewal options and make an informed decision. However, there are bad actors out there, and this is what drives me crazy, that will hold on to that renewal until the day before your renewal date. And it is a tactic because it gives you and your board very little time to review your renewal policy or compare and contrast it to other options out there. It's so that they can keep the business. Now, there is a caveat to that,
Yes.
because I'll tell you, the surplus lines market, the wild, wild west, if you will, They work on a completely different timeline. And some of those renewal policies, we are not getting 30 to 40 days. However, we should be transparent in that and let you know
Yes.
what's going on, when we might expect it, and be there to answer those questions. So
100%. And I would just add that they're going to be the cause of my early grave.
it's so true. And then last but not least, and again, this is also a tactic that I can't stand. You have every right to your loss history information. So this is another tactic. Some bad actors will be asked for loss history that belongs to you, and we can easily generate a report in most situations, but they will hold on to it until either last minute or completely ignore your request. This is because this is a little flag for us that, oh, if I've got a client that's asking for loss history, chances are they're shopping around.
Right.
Yes, we know that. But if we are doing our job and being as proactive as possible and being a good partner to you, then that shouldn't scare us. And you have every right to your loss history. So I always like to call out those bad actors, call a spade, and watch out for those red flags.
Yep.
Oh, that leads us to the end of our presentation. Here on the screen is Patrick and my contact information, and I think we do have a few minutes to offer a little bit of Q&A if there's any questions out there.
Fantastic. Well, we do have a couple in the Q&A, so I will read them. Um, so, an owner received a letter from their carrier that they're not renewing their policy. They have coverage until August 2nd. How do I choose another insurance company? What questions should I be asking before committing to an insurance company? Do insurance companies give discounts for personal homeowners insurance if everyone in the condo building purchases with the same insurance company? So that's a lot of questions all
A
wrapped
lot of
into one.
questions, but we can address them all.
Some of which I think you guys went over, but yeah, any thoughts?
Well, I can just tell you, Charlotte went through a really good list of how to pick a broker, and that was really well done. I would just add on the second part of the question as far as discounts. I only know of one company that will give an association discount, not the unit owner, but the association's discounts. And the trigger is if a board member has a HO6 and an auto with that same company. And it can be, $500 as much as the max is $500 actually, but the premium has to be like, $40,000, $30,000 for it to hit that. So that is possible. As far as HO6 policies getting discounted, it's just very difficult to find that. It's not available in my view of it, and I don't think it would be because the HO6 carriers are really struggling. And you might be wondering, well, why are they struggling? Besides all the wildfires and whatnot, they're struggling because the HOAs are having to increase their deductibles. So that means more of the claim falls on the individual HO6 policy. So they're kind of retooling and increasing premiums, and they're not super interested in the actual discount for that. I wish it was the case, but it's simply just truly not. But as far as how to pick brokers, yeah, I mean, I concur with what Charlotte said as far as, finding someone that's a CERMS, active in the industry, maybe get a referral from some managers, for instance. They're out there, but I would say that, I mean, truly the HOA specialist, it's funny because I run into agents and they say, oh, I'm Bob, I'm an HOA specialist. And I find out they have 5 HOAs, they're out there. The true specialist, we all know each other. And there's probably, I'm going to say, fewer than 25 in the state. And I think I'm being generous.
I think you're being generous. Yeah.
You got being generous?
Yeah, I do. I really do.
It might be like 20 or 15.
And I will just add to that, and this is what I tell folks too, if you are truly looking for a new agent or broker, and your best bet is to work with one broker, and I will say this, and one agent. So, and we're going to get into the weeds a little bit for just a second, but there are direct writers, right? So Farmers, State Farm, Allstate, those are your direct writers that have access to that policy for you. A broker like me, I don't have access to Farmers, State Farm, or Allstate. So I think it behooves you to work with an agent and one broker, not 3 brokers, because we're really kind of oversaturating the same market. And those applications can look different, and the relationships that those insurance brokers have with the insurance carriers can look different. And so we want to really kind of go with a broker that we feel confident with and trust their leverage with those carriers. So what I tell folks is if you're looking for a new broker, find three, again, through word of mouth. If you have, friends that live in homeowners associations, have had a good experience. If you do belong to an industry like CAI, CACM, Echo, and find, three brokers that you'd like to consider and give each of them just 5 or 10 minutes on your next board meeting. Have one come into the Zoom room or in person, excuse them, the next one come in, and ask some of the questions that you saw on my checklist. Ask them truly, what designations do you have? How many homeowners associations do you insure? What does your renewal process look like? Walk me through who I'm going, who's going to be my contact and, where are you from? What do you do? That kind of stuff. Interview and then feel confident in who you're choosing and work with that one broker. The other thing that I'll mention to the person that asked the question or questions is one, it could be, and I don't know your situation, that the insurance carrier non-renewed you for whatever reason. But if you're already working with a broker, they should be well aware of the non-renewal, and you should probably already have really great open communication with them on what their plan is as the insurance provider. This happens, right? We have a client, they get non-renewed by an insurance company, and we're on it immediately saying, hey, no problem. We're already taking this out to the open market anyway, because that's what we do upon renewal each year. And we're going to find you some replacement coverage. So I'm hoping that that's happening for you. But if you're saying, who do I work with next? I'm going to have to assume that maybe that conversation isn't taking place. Yeah. But if you were working with, a real professional in the industry, they should already be walking you through that process.
Yeah, I would agree. But we don't know. I don't know if the question was for an HO6 non-renewal or an HOA.
Oh,
so I'm not sure on which that is.
Good
HO6
point.
It'd be more common for you not to have a lot of, contact. That would be this wrong, but it's not as uncommon as
Good point. Good point.
Okay, so someone says my HOA is located in Murrieta, a city that has been certified for fire risk reduction, which is supposed to reduce our insurance rates. What is your experience with this?
Well, Murrieta that's in my territory, by the way. I'm about 30 or 40 minutes away from Murrieta. Murrieta has been very difficult. A lot of companies have pulled out of Murrieta going back to 21, but now they are starting to come back, and the FAIR Plan definitely is helping that. So we do have carriers that are doing it. As far as the fire safety, that does not go unnoticed. Now, one thing people ask about as far as discounts, like what discounts can we get if we have certain community Firewise program, for instance? And unfortunately, the discounts have not really come to market yet, but I'm not saying that they won't. I think that they will eventually. Fair Plan right now gives some discounts. You can earn them one by one. And other insurance companies are like, they're not really looking to add discounts, but I could see the Department of Insurance coming to a situation with an insurance company to say, you come in the market more and we'll give you some discounts. And so I could see them having that, or they'll say, Department of Insurance say, we'll give you a little premium increase, but you got to give us some more discounts. So that is something that's a work in progress. So I would say Murrieta is thawing out for sure. We have a lot of clients down there, and we have standard companies in that area. And there are others that if you're up in the hills, they're too far away. It's a bit of a problem. The thing about Murrieta that has going in for any community, for anybody that's listening, is that what really solves wildfire concerns, it's true that, weed abatement and brush abatement is important, but I'll tell you what really cures it: development. Development cures wildfire areas. And that's what Murrieta has going on. Murrieta has a lot of development going around in the foothills. That's going to help your fire score overall.
Okay, thank you. Someone said, how do you determine how much coverage you should have for a townhouse? I've asked several agents and they can't answer. There are calculators for single family, but since our HOA is walls in, it's different. So how do they determine how much coverage they need?
Well, you want me to take that, Charlotte?
I'm going to leave that to you because you know more about personal lines than I do any day.
So what you do is that, I was going to ask a question. It's like, what does the association insure? But now, since the question had the word walls in, then what that's telling me is that the association covers the exterior of the building, coming all the way to the unit, and they go into the interior of the unit as the developer left it behind. So there was flooring, there was cabinetry, there were countertops, build out the walls, all that was done. I'm assuming that that's the situation for the answer. So if that is true, then what you would do is you would figure out what was that base model look like? Like, did you put in hardwood floors when there was tile, or a previous owner did? Custom cabinetry, maybe extra plumbing fixtures. Maybe you added a loft inside your unit because it's a 2-story and you had a loft and maybe you enclosed it to a room, or as a high ceiling, you created a loft. Those types of things, you get the value of those things, and that's what you would insure for. Then I would take the final step and I would probably add 10 or 20% just as a buffer, because your premium is not going to change very much. I mean, it's not going to change, that's not really move the needle. So again, figure out what is the true upgrades. Because keep in mind, on a walls in policy, the association policy is going to give you back everything as the developer left it. So you only need to do your upgrades. Now, as far as the values go, and the reason why we can't come to hard numbers is because we don't know what's in your home. Even your personal agent probably doesn't know. Maybe he or she will visit and kind of help you do an assessment, but it's probably something you could do on your own, and kind of talk it through with your agent about that. But you don't need to worry about the walls and the structure. That's handled by the association.
Thank you. So someone wrote and said, is it always the insurance broker that's using bad tactics and not sending the renewal in a timely manner for the board review? Can the community manager also be contributing to that? My association was given a week to review and approve the policy before the insurance lapsed. How can we hold the broker and the manager accountable? So I'll talk about the management side.
I was just going to say, not Matt.
Yeah, so I mean, it's very company dependent. It's very manager dependent. So one, I'll say, like our firm, for instance, we have a person whose job it is to look at all of our community's insurance policies, go out, contact these brokers months in advance to try and get renewal quotes out of them. It's gotten a lot harder over the years just because, again, the insurance market has changed so much and is changing so rapidly that carriers are having less and less appetite for giving quotes a month in advance, right? They don't know what's going to transpire in the time leading up to binding that policy. So they're really being cautious about it. Now, to the point that I think Charlotte made earlier, which is, if you have a solid broker or a solid agent who's working on your behalf, right, they're going to be communicative, they're going to be responsive and let you know if there are delays and if you're not going to see something, with much notice, and, they're going to be having those tough conversations with you. So, the other thing that I will just 100% tell you is that as board members, the buck really does stop with you, and we rely right on your management company, on your broker, on all of these people to make it happen. I will say, I encourage you, if your management company is not providing you with a calendar, right, of when things renew, of when things are happening, make your own calendar. Make sure that you're aware, because the last thing you want to do is for the community to get caught unawares without proper coverage. And you can do a postmortem and point the finger all you want, but you guys are really the ones on the hook for that. So, we do all we can, but do just make sure that, you guys are kind of being diligent about following up with your contractors. So, Charlotte, Patrick.
I would also add, I don't think that in any stretch of the imagination, board members want to be CC'd on anything and everything. Community managers are juggling so much and so many details on your behalf as the association and as board members. However, I will say, when it comes to the insurance renewal, it renews once a year. What we ask our community managers, if you have one, is, hey, is there a board member or board members you would like us to carbon copy on the proposal itself? Doesn't mean you need to be on the back and forth on all of the things. Hey, updates made to the association, that can often be handled through the community manager who has that information at their fingertips. But certainly, if the manager wants us to CC the board on that proposal, that can be really helpful. So that if the manager is managing other properties or on vacation, because everyone deserves a vacation, then the board can receive it right then and there and start reviewing or the review process immediately. So that is also an option. I wouldn't want them CC'd on everything. That's just too much to handle and it's unfair to your inbox, but on the proposal itself.
Yeah, and I mean the really great, brokers in our industry, they are so happy to talk with board members to discuss your community's insurance needs. So yeah, obviously you're going through a manager and you hired them to kind of take the workload off of you. I also encourage, to the extent that you're interested and comfortable in kind of bridging a personal relationship with that broker, do it, right? They love educating, obviously, as you've seen tonight. So, lean on them. And yeah, they're here to help.
Absolutely.
Well, I don't see any other questions coming through, so I think we can go ahead and wrap up. But I just really, really want to thank Charlotte and Patrick for sharing their expertise tonight.
Thank
I
you.
want to thank all of you for coming and getting educated, which is fantastic. We're going to be distributing a recording of this presentation, so you can review it at your leisure. And we hope everyone has a great night, and we will see you soon.
Thanks for having us,
So
Matt.
much.
Thank you,
Have a
everybody.
good night.
Bye,
Thank you,
everyone.
Charlotte.
Bye, Patrick.